You know what's fascinating? While everyone's been obsessing over gold hitting new highs, something extraordinary has been happening in the silver market that almost nobody is talking about. And I'm not exaggerating when I say this could be the last opportunity you'll see to position yourself before this market explodes in a way we haven't witnessed in decades. Let me paint you a picture of what's actually happening right now. Silver just hit levels we haven't seen since the early 1980s, when the Hunt brothers tried to corner the market. But this time, it's not speculators driving the price. It's something far more powerful and far more permanent. We're watching the convergence of multiple forces that are creating what market analysts are calling a perfect storm for silver prices. Here's what most people don't understand. Silver isn't just a precious metal anymore. It's become absolutely critical to the technology that's reshaping our world. Every single solar panel requires silver. Every electric vehicle uses significantly more silver than traditional cars. The AI revolution everyone's talking about, those data centers and AI chips are silver intensive. We're talking about industrial demand that's structural, not cyclical. This isn't going away. Let me give you some numbers that should make you sit up and pay attention. Industrial demand now accounts for nearly 60% of total silver consumption. That's a complete transformation from just 20 years ago. And here's the kicker. That percentage is climbing every single year. The photovoltaic industry alone is consuming record amounts of silver, and with governments around the world pushing green energy mandates, that demand is only accelerating. But demand is only half the story. Let's talk about supply, because this is where things get really interesting. The silver market has been running a supply deficit for 5 consecutive years now. Think about that. 5 years where demand has exceeded new supply. That's not a blip. That's a structural imbalance. And unlike gold, you can't just decide to mine more silver when prices go up. Why? Because roughly 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. Silver miners don't control their own production destiny. Here's something that should concern anyone paying attention. Global silver inventories have been declining steadily. The stockpiles that used to act as a buffer, they're being drawn down. The COMEX warehouses, the London vaults, we're seeing metal leaving these facilities at rates that would have been unthinkable just a few years ago. And once that physical metal moves into industrial applications, it's gone. It gets consumed. Unlike gold, which mostly sits in vaults and jewelry, silver gets used up in manufacturing processes, where it's often not economical to recover. Now let me tell you about something that's been happening behind the scenes that the mainstream financial media has completely missed. Central banks, the same institutions that have been accumulating gold at record pace, are starting to look at silver differently. They're recognizing that in a world moving toward green technology and digital infrastructure, silver isn't just a monetary metal, it's a strategic resource. Some smaller central banks have already started adding silver to their reserves. That's a seismic shift in thinking. And speaking of institutional behavior, let's talk about what the smart money is doing. Major investment funds have been quietly building positions in silver. Not the paper silver traded on exchanges, but physical silver. They're taking delivery. They're moving metal into private storage. Why would sophisticated investors with teams of analysts be doing this? Because they can read the same supply and demand data you and I can see, and they're drawing the obvious conclusion. Here's where it gets even more interesting. The gold to silver ratio, which historically has averaged around 60 to 1, recently touched levels above 80 to 1. That means silver was dramatically undervalued relative to gold. When you see distortions like that in markets, they don't last forever. They correct. And when they correct, the moves can be violent and swift. We've already seen silver start to catch up, but many analysts believe we're still in the early innings of this revaluation. Let me take you back in history for a moment, because understanding the past helps us see where we might be headed. In 1980, silver hit $50 an ounce. Adjusted for inflation, that's over $170 in today's money. Now, I'm not predicting we'll see those levels, but I want you to understand the potential volatility and upside in this market. When silver moves, it moves fast, and it moves big. The metal has a history of explosive rallies that leave investors who waited on the sidelines kicking themselves. But here's what's different this time compared to 1980. Back then, it was speculation and manipulation driving prices. The Hunt brothers were trying to corner the market artificially. This time, we have genuine, structural demand from industries that are growing exponentially. We have supply constraints that can't be easily fixed. We have a monetary environment where central banks are printing currency at unprecedented rates, making hard assets more attractive. And we have a geopolitical landscape that's increasingly unstable, driving safe haven demand. Think about what's happening in the electric vehicle market alone. A traditional car might use 15 to 28 grams of silver. An electric vehicle uses 25 to 50 grams. Some estimates put it even higher for certain models. Now multiply that by the millions of EVs that automakers are planning to produce over the next decade. That's not a small amount of silver. That's a massive, sustained increase in industrial demand that has to be met somehow. And then there's the solar industry. Every solar panel requires silver paste for the electrical contacts. As solar installations accelerate globally, and they are accelerating dramatically, that's creating demand for silver that simply didn't exist a generation ago. China alone is installing solar capacity at a pace that's staggering. Europe is pushing hard into renewables. Even the United States, despite political debates, is seeing significant growth in solar installations. All of that requires silver. Now, let me address something important for anyone thinking about their financial future and retirement security. If you're sitting on retirement accounts and you're concerned about inflation, currency debasement, and the stability of traditional financial assets, you might want to understand how physical precious metals can fit into a retirement strategy. I've put together a comprehensive guide on how gold IRAs work. It's completely free and you'll find it in the description below. It covers how you can get physical gold and silver into your retirement account without triggering tax penalties, and it's particularly relevant if you have $100,000 or more in retirement savings. Worth taking a look if that applies to your situation. But let's get back to what's happening in the silver market right now, because the timing of all this is critical. We're at a point where multiple trend lines are converging. The supply deficit is widening. Industrial demand is accelerating. Investment demand is picking up as more people recognize the opportunity. And the macroeconomic backdrop, with concerns about inflation, debt levels, and currency stability, is creating an environment where hard assets become increasingly attractive. Here's something that doesn't get talked about enough. The paper silver market, the futures contracts and derivatives traded on exchanges, is massive compared to the physical silver market. Some estimates suggest there are hundreds of ounces of paper silver claims for every ounce of physical silver that could actually be delivered. That's not necessarily a problem when everyone's content to trade paper. But what happens when a significant number of holders decide they want physical delivery? We've already seen stress in the system during periods of high demand. The premiums on physical silver coins and bars have spiked well above the spot price at various times, indicating tightness in the physical market. Let me tell you about what happened during the pandemic. When lockdowns hit and mints shut down, we saw premiums on silver coins explode. People who wanted to buy physical silver were paying $5, $6, even $7 over spot price per ounce. Why? Because you can't print physical silver. You can create all the paper contracts you want, but when people want the actual metal in their hands, supply is limited. And we're heading into a period where more and more investors are likely to want physical rather than paper. Think about the geopolitical dimension for a moment. We're watching a gradual but unmistakable shift away from dollar dominance. The BRICS nations are exploring alternatives to the dollar for international trade. Central banks globally are diversifying their reserves. When confidence in fiat currencies erodes, where does money flow? Historically, it flows to tangible assets. Gold and silver have been money for thousands of years. They've survived every currency collapse, every empire's fall, every financial crisis. That's not changing. And here's something that should concern anyone paying attention to monetary policy. Central banks have painted themselves into a corner. Debt levels are astronomical. Any significant increase in interest rates threatens to make that debt unsustainable. But keeping rates low while running massive deficits is inherently inflationary. It's a no-win situation, and the likely outcome is continued currency debasement. In that environment, hard assets aren't just attractive. They're essential for preserving purchasing power. Let's talk about the mining side of this equation, because it's crucial to understanding where supply is headed. Silver mining is not particularly profitable at current prices for primary silver miners. Most silver, as I mentioned, comes as a byproduct. But even for primary silver miners, the economics are challenging. Ore grades have been declining. Energy costs are rising. Environmental regulations are getting stricter. All of this means that even if silver prices rise, we're not going to see a flood of new supply hitting the market quickly. It takes years to bring new mines online, and many potential projects aren't economically viable even at higher prices. Here's a scenario that keeps some market analysts up at night. What if we see a real supply crunch? Not just a deficit on paper, but an actual shortage where industrial users can't get the silver they need for manufacturing? We've seen glimpses of this during the pandemic disruptions. Imagine if that became sustained. Industrial users would have to bid up prices to secure supply. That would create a feedback loop where higher prices attract investment demand, which further tightens physical supply, which drives prices even higher. Now, I want you to think about your own situation for a moment. Where are you positioned for what's coming? Most people have their wealth in traditional assets: stocks, bonds, real estate, cash. Those all have their place. But in an environment where we're seeing structural changes in the global monetary system, accelerating industrial demand for strategic metals, and supply constraints that can't be easily fixed, having some exposure to physical silver isn't speculation. It's prudent diversification. Let me give you another historical parallel. In 2008, during the financial crisis, silver initially dropped along with everything else as investors liquidated positions. But then something interesting happened. As central banks responded with unprecedented monetary stimulus, silver went on a massive run. From late 2008 to 2011, silver went from under $9 an ounce to nearly $50. That's more than a five-fold increase in less than 3 years. Why? Because investors recognized that the monetary response to the crisis was going to be inflationary, and they positioned accordingly. We're in a similar situation now, except the monetary stimulus has been even more extreme. The amount of currency creation we've seen over the past few years dwarfs what happened after 2008. And unlike that period, we now have massive structural industrial demand for silver that didn't exist back then. The electric vehicle revolution was barely a concept in 2008. Solar was a tiny fraction of what it is now. I wasn't consuming massive amounts of electricity and requiring silver-intensive infrastructure. All of those are new demand drivers that are layered on top of the monetary dynamics. Here's what concerns me about the current moment. We're at a point where the opportunity is still available, but the window is closing. Silver is still relatively affordable. Physical metal is still available, though premiums have been creeping up. The mainstream hasn't fully caught on yet to what's happening, but that's changing. More analysts are writing about the silver story. More investors are paying attention. More industrial users are getting concerned about securing long-term supply. Once this becomes consensus, once everyone sees what's happening, the opportunity to position yourself advantageously will have passed. Think about it this way. Every major market move has a period where the smart money is accumulating quietly before the crowd catches on. We saw it with gold in the early 2000s. We saw it with Bitcoin in its early years. We saw it with tech stocks in the 90s. The people who made life-changing returns weren't the ones who bought at the top when everyone was talking about it. They were the ones who recognized the opportunity early and had the conviction to act before it became obvious. Let me address a question I know some of you are thinking. What about the risks? What could go wrong with this thesis? It's a fair question, and anyone making investment decisions should consider both sides. The main risk would be a severe global recession that crushes industrial demand. But even in that scenario, the monetary response would likely be even more stimulus, which would support precious metals prices. Another risk would be a major new silver discovery or a technological breakthrough that reduces silver usage in key applications. But there's no indication of either on the horizon. Here's something else to consider. Silver has utility beyond just being a monetary metal or an industrial commodity. It has unique properties that make it irreplaceable in many applications. It's the best conductor of electricity and heat. It has antimicrobial properties. It's highly reflective. These aren't things that can be easily substituted. Engineers have tried to find alternatives to reduce silver usage in various applications, and they've had limited success. In many cases, silver is simply the best material for the job, and there's no viable substitute. Now let's talk about what smart positioning looks like in this environment. I'm not suggesting anyone put their entire net worth into silver. That would be reckless. But having a meaningful allocation to physical precious metals as part of a diversified portfolio? That's just common sense, given what we're seeing. Some financial advisors suggest 5 to 10% of investable assets in precious metals. Some suggest more. The right amount depends on your individual situation, risk tolerance, and financial goals. But here's what I can tell you with confidence. Doing nothing, staying entirely in traditional financial assets, and hoping that the current monetary system continues indefinitely without consequences, that's also a risk. It's a bet that central banks can continue printing currency without inflation, that debt levels don't matter, that the dollar will remain the world's reserve currency forever, and that we won't see any major disruptions to the financial system. Maybe that bet pays off, but is that really a risk you want to take with your financial future? Let me paint you a picture of what the next few years could look like. We're likely to see continued monetary instability. Inflation may come in waves rather than being a one-time event. Geopolitical tensions are probably going to increase rather than decrease. The transition to green energy is going to accelerate regardless of political changes. AI and technology infrastructure build-out is going to continue consuming massive amounts of resources. All of these trends favor silver. And here's the thing about silver that makes it particularly interesting compared to gold. Silver is more volatile. That cuts both ways. It can drop harder, but it can also rally harder. When precious metals are in a bull market, silver typically outperforms gold on a percentage basis. We saw this in the 2000 to 2011 period. We saw it in the 70s. The leverage to gold that silver provides is significant, and for investors who can handle the volatility, that's an attractive feature. Think about the psychology of markets for a moment. Right now, most investors aren't thinking about silver. It's not making headlines. It's not the hot trade everyone's talking about. That's actually when the best opportunities exist. By the time something is on the cover of major financial magazines and everyone's talking about it, you're late. The real money is made by those who see the opportunity before it becomes obvious, who do their research, who understand the fundamentals, and who have the courage to act when others are still skeptical. I want to be clear about something. I'm not telling you what to do with your money. That's a decision only you can make based on your own research and circumstances. What I am telling you is that there's a compelling case to be made that we're at a unique moment in the silver market. The fundamentals are strong. The supply-demand dynamics are favorable. The macroeconomic backdrop supports hard assets, and the opportunity to position yourself is still available. But opportunities don't last forever. Markets have a way of moving faster than people expect once they start moving. We've already seen silver make significant moves from its lows. Many analysts believe we're still in the early stages of what could be a multi-year bull market, but each day that passes, each dollar that silver rises, the opportunity becomes a little less compelling. The risk-reward ratio shifts. The potential upside diminishes while the downside risk increases. Here's what I'd suggest you do. Take some time to really understand what's happening in the silver market. Look at the supply and demand data. Study the historical price patterns. Think about the macroeconomic environment we're in. Consider your own financial situation and what role precious metals might play in your portfolio. And then make a decision. But make it soon, because this window of opportunity isn't going to stay open indefinitely. The silver market is telling us something important right now. It's telling us that we're at an inflection point. The question is whether you're going to listen to what the market is saying, or whether you're going to wait until it becomes obvious to everyone. By the time it's obvious, the easy money will have been made. The people who will look back and wish they had acted will be the ones who saw the opportunity, but didn't have the conviction to do anything about it. This isn't about getting rich quick. This isn't about speculation or gambling. This is about recognizing a fundamental shift that's happening in a critical market and positioning yourself accordingly. It's about understanding that the world is changing, that the monetary system is under stress, that industrial demand for strategic metals is accelerating, and that supply constraints are real. It's about taking prudent steps to protect and grow your wealth in an uncertain environment. So here's my challenge to you. Don't just take my word for any of this. Do your own research. Look at the data. Study the trends. Talk to people who understand these markets, and then make an informed decision about whether silver deserves a place in your portfolio. But do it now, while you still have the opportunity to act before the crowd catches on. Because once this becomes consensus, once everyone sees what's happening, the opportunity to position yourself advantageously will have passed. This is your last chance to get ahead of what could be one of the most significant market moves of the next decade. The question is, are you going to take it?